What if I told you that Ethereum isn't just money? That it's evolving into something far more foundational, with the potential to become the world's first decentralized bond, a kind of internet bond for the digital age. It might sound far-fetched, but when you look at the direction Ethereum and decentralized finance are heading, this idea is gaining traction among leading thinkers, investors, and institutions. In this exploration, we'll unpack why many experts believe Ethereum could become the digital treasury asset of the future, and why its role in the global financial landscape may be just beginning. Let's start with the basics. What is a bond? In traditional finance, a bond is a simple but powerful instrument. When you purchase a bond, you're lending money to a government, corporation, or other entity, and in return, you earn interest, known as the coupon. These aren't just numbers on a screen. They represent predictable, passive income streams that have powered savings and investment for centuries. U.S. Treasury bonds, for example, are considered one of the safest assets on Earth. You lock in your capital, you earn a yield, and your investment is backed by the full faith and credit of the government. Bonds are the bedrock of traditional finance, reliable, trusted, and the very definition of risk-off assets.
But here's the big question. Can a decentralized digital asset like Ethereum offer something similar? Can it provide not just speculation, but a predictable, yield-bearing experience without relying on any single government or corporation? This is where Ethereum's transformation gets interesting. With the shift to Ethereum 2.0 and the adoption of proof-of-stake, ETH holders can now stake their tokens and earn a real, ongoing yield, currently ranging from roughly 3% to 5% annually, depending on network conditions. Think of it in bond terms. By staking your ETH, you're effectively locking your capital, and in return, you earn yield, much like receiving the coupon from a bond. This is passive, predictable income enabled by the very structure of Ethereum's consensus mechanism. But there are some key differences. Unlike traditional bonds, Ethereum has no central issuer. There's no government printing more, no central bank adjusting rates on a whim. And, thanks to EIP 1559, Ethereum's supply is actually deflationary over time. Every transaction burns a portion of ETH, making the asset gradually scarcer. So, as you earn yield by staking, you're also holding an asset that's becoming more rare and potentially more valuable with every block that's mined and every transaction that's processed. It's a combination of passive yield and built-in scarcity that traditional bonds simply can't match. This is the foundation of what some experts call the internet bond thesis. It's not just a catchy phrase. Leading investment firms like A16Z, ARK Invest, and Fidelity have all discussed the idea that Ethereum is more than just a crypto asset. It's positioning itself as the base layer of a new decentralized financial system. Why? Because Ethereum offers something truly novel: programmable yield enabled by smart contracts. Instead of being locked into a fixed interest rate set by a central authority, Ethereum's yield is dynamic, governed by the code and consensus of its global network. Moreover, Ethereum is borderless and censorship-resistant. It doesn't matter where you are in the world. If you have an internet connection and some ETH, you can participate in staking, lending, or using ETH as collateral. It's liquid, transferable, and native to the Web3 economy. In short, ETH isn't just a store of value. It's becoming a store of productive, yield-generating capital. In this sense, Ethereum is redefining what it means to be a bond in a digital, decentralized world. Let's take this a step further and look at Ethereum's role as collateral. In the world of decentralized finance, or DeFi, Ethereum is already being used as the foundational layer for a wide array of financial products. Take MakerDAO, for example. Users lock up ETH as collateral to mint the stablecoin DAI, creating a decentralized, algorithmic equivalent of borrowing against government bonds. On platforms like Aave and Compound, ETH serves as collateral for lending and borrowing, with transparent on-chain risk management replacing the opaque processes of traditional banks. This use of ETH as collateral is already drawing the attention of major institutions.
As real-world assets become tokenized and brought on-chain, and as more financial applications are built atop Ethereum, ETH itself is being treated as a kind of digital base layer capital, much the way government bonds underpin the traditional financial system. In a world where intermediaries are replaced by code and trust is enforced by consensus, Ethereum could become the ultimate low-risk capital asset, powering everything from decentralized loans to global payments. So what does all of this mean for the big picture? Ethereum is evolving rapidly. It's no longer just a utility token for paying transaction fees, nor is it merely a speculative asset to be traded on exchanges. Instead, it's becoming a yield-generating, deflationary, programmable, borderless, and decentralized bond, a financial primitive for the next generation of global commerce. As its ecosystem grows, as more institutions adopt it for collateral and yield, and as its deflationary mechanics kick in, Ethereum is positioning itself as the internet bond, the digital equivalent to the US Treasury bond, but with the added features of programmability, global accessibility, and resistance to censorship. So, the next time someone asks you, "What crypto should I hold for long-term passive income?" the smartest answer might just be ETH. Not just as a speculative bet, but as a foundation for a new era of digital finance, the internet bond, accessible to anyone, anywhere, at any time. If you found these insights valuable, consider sharing this perspective with those who still see crypto as just speculation. The landscape is shifting, and Ethereum is leading the way. But what do you think? Is Ethereum really the bond of the future, or is it just another digital bubble? The conversation is just beginning, and your perspective matters.